Welcome to Talk Tickers, the show for the buy-side mind. Today, we're heading to the Pacific Northwest.
That's right.
We're looking at a bank that just reported earnings, and on the surface, it looks like a revenue miss. The top line was a little light.
It was.
But the stock is green. It popped over 2% in the pre-market, held those gains, and on, double the average volume.
Yeah, almost 500,000 shares traded, so clearly the market has seen something else.
Exactly. Something that a quick glance at the headlines might miss. We are talking about Banner Corporation, ticker BANR.
And this is just a classic case where the how matters so much more than the what. You look at Banner and you see what I like to call the super community bank model playing out.
Right.
This isn't about flashy growth. It's about being incredibly boring in a way that, it generates a lot of cash.
Boring is beautiful.
When it preserves margins like this. Absolutely.
So let's set the scene. Banner Corp, Q4 2025 results. Revenue came in at about $167.7 million, a technical miss. But the buy side didn't care.
Not at all.
They were buying the stock up in the mid $67.
Yeah.
And the reason, I think, is this margin story. It's just incredible given the environment.
It really is. And to get why the stock moved, you have to look right past that revenue number and go to the EPS, the earnings per share.
Okay.
They reported a GAAP EPS of $1.49. Now that's down from $1.54 last quarter, so sequentially, it's a dip. But, and this is the whole story, the street was looking for $1.45, maybe $1.46.
So a nearly 10-cent beat, that's not small for a regional bank.
It's a big beat. And it leads us right to the star of the show here, the net interest margin, or NIM.
I saw this number and I actually had to double check it. They reported a tax equivalent NIM of 4.03%.
Crossing that 4% line, it's a huge psychological win. It's up from 3.98% last quarter and way up from 3.82% a year ago.
Okay, wait, hold on. Before we get too excited, let's unpack tax equivalent. We hear that a lot with banks. Is this just some kind of accounting trick to make the number look bigger?
It's a fair question, but no, it's not a trick. It's about getting an apples-to-apples comparison. Yep. See, banks hold things like municipal bonds, and the income from those is tax exempt. So the yield looks lower on paper. Tax equivalent just grosses that number up to show you what the yield would be if it were taxable. It gives you the true earning power.
Got it. So 4.03% is the real horsepower. But here's what I don't get. The Fed just cut rates by 75 basis points.
Right.
Usually when the Fed cuts, bank margins get squeezed. So how is Banner expanding their margin when the price of money is getting cheaper?
That is the margin miracle right there. And you're exactly right. Their earning asset yields did drop. They fell by about 4 basis points. That Fed cut immediately hits their floating rate loans.
Okay, so the money coming in is shrinking a little bit.
A little bit. But the key is the cost of the money going out, the interest they pay on deposits, it dropped even faster. Their funding costs fell by 10 basis points.
I see. So the spread actually got wider.
Exactly. It's all about that delta. They were really aggressive in cutting what they paid depositors. And the reason they could get away with that is because of their deposit mix. A massive 33% of their deposits are non-interest bearing.
Meaning they pay 0%.
Zero. They pay absolutely nothing for a third of their funding. That's the dream.
That's the engine room.
It is. But there's another piece to this puzzle. It's what we call the back book. Even though new loans they're writing are at lower rates, around 6.88% this quarter.
Which is down from over 7% before, right?
Correct. But they still have all these old loans on the books from years ago that were written at, say, 3 or 4%. As those mature and roll off, they're being replaced by these much higher yielding loans.
It's like a conveyor belt. The old cheap stuff falls off the end and the new, more expensive stuff gets put on the front. So even if today's new is a little cheaper than last month's new, it's still way better than what's falling off.
That is the perfect analogy. It creates this natural tailwind that helps them fight against those Fed cuts.
Okay, so let's talk about safety. We all remember 2023, the regional banking crisis. The problem there was hot money, right? Flighty deposits that just vanished overnight. Banner keeps pushing this super community strategy. Is that just marketing, or is their balance sheet actually different?
No, it's fundamentally different. The metric you have to look at is core deposits. Management made a point to say that 89% of their total deposits are considered core.
And define core for us. What does that actually mean?
Core deposits are sticky. These are the checking accounts for local businesses in Walla Walla. It's the savings account for a family that's banked with them for 20 years.
So it's not some hedge fund parking cash for 3 weeks to chase an extra few basis points.
Exactly. When rates move, hot money is gone. Core money stays because it's a relationship. It's inertia.
So 89% of their funding is basically locked in. And that stability lets them run with a loan-to-deposit ratio of what, 86%?
86%, which means for every dollar in deposits, they've only lent out 86 cents. It's a very healthy, conservative place to be. It means they have dry powder.
And they're using some of that powder for buybacks. I saw they bought back about 250,000 shares in Q4.
Yeah, around the 63.30 level. Looks like a pretty good trade right about now.
It does. But let's pivot to the ugly part of the report. We have to be objective. I mentioned the EPS beat, but sequentially, earnings were down, and the expense line had some interesting items.
Yes, the expense noise.
You call it noise, but it's real money. They had a $1.4 million loss on asset disposals. $1 million of that was just writing off software they aren't using anymore.
Right.
I have to be the skeptic here. When a company writes off software, isn't that just code for we made a bad decision a few years ago and now we're burying it? Why does the market give them a pass on that?
It's a fair point.
Yeah.
Somewhere, money was spent on tech that didn't pan out. But the market tends to forgive it if it's seen as cleaning house. The argument is that it's a sunk cost. Just wipe it off the books so the future numbers look cleaner.
The old kitchen sink quarter.
A mini one, yes. They also had a $2 million fair value decrease on some financial instruments. And get this, a spike in medical claims. Apparently, everyone went to the doctor at the end of the year.
Back-end loaded deductibles. Classic.
It's a classic. But if you strip all that noise out, the software, the fair value dip, the medical claims, the underlying operating run rate is really strong, and management is guiding 2026 expenses to just a normal 3% inflationary increase.
So the thesis is, the core business is printing money, the expenses were just some housekeeping. Okay, let's move to credit. This is where the skeletons usually hide, especially with all the anxiety around commercial real estate.
You'd expect to see some cracks, but the metrics are, frankly, pristine. Non-performing assets are just 0.31% of total assets. It's basically nothing.
I was digging through the details and I found something. It's small, but it feels significant. There was a spike in special mention loans.
The watch list, right?
The watch list.
Yeah.
And management specifically said this was from downgrading a couple of relationships in alcoholic beverage-related enterprises.
The alcohol downgrade. I love this detail.
They cited declining cash flows. The biggest one was a $25 million loan. Now, hold on. We're always told alcohol is recession-proof. People drink when times are good. People drink when times are bad. Are you telling me people are drinking less?
Well, it seems these people are. This is almost certainly the craft beverage, space breweries, distilleries, and it might be a little signal that the consumer is finally hitting a wall. That $18 four-pack of craft IPA is one of the first things to go when you tighten the belt.
That's fascinating. So it's an idiosyncratic credit issue for the bank, but it's also like a canary in the coal mine for discretionary spending.
It really is. But from a banking perspective, you'd much rather see the issue be isolated to booze than, say, your entire office portfolio.
Good point. No systemic fire here. Okay, so let's talk about growth. Or the lack of it. The loan portfolio was basically flat. They originated 9% more loans, but the total balance didn't move. What's going on there?
It's the churn. They're running just to stand still. They're seeing a lot of high payoffs, especially in commercial real estate and affordable housing tax credits.
Why are people paying off loans?
Asset sales, mostly. Properties are changing hands. But the more telling metric for the economy is in their commercial and industrial, their C&I book. Line utilization was down 3%.
Okay, ELI 5, that for me, line utilization.
Think of it like a business's credit card. A company has a $10 million line of credit to buy inventory, whatever. Utilization is how much of that limit they're actually using.
So when utilization drops, it means businesses are paying down their balances and not borrowing more.
Exactly. They have the credit card, they're just not swiping it. It suggests a lot of caution out there. Business owners are hunkering down.
Which brings us to the Fed. This is probably the most critical part of the whole story. The CFO, Rob Butterfield, he laid out this whole roadmap for their profits based on what the Fed does.
This is the logic tree. It's so important for anyone trying to model this stock, and it all hinges on a term called deposit beta.
Right. Which is just a fancy way of saying for every 1% the Fed moves rates, how much does the bank pass on to its depositors?
Precisely. They're modeling a 28% beta, which is really low. It means they only pass on about a quarter of any rate move. That's a huge advantage.
Okay, so with that 28% beta in mind, let's go through the scenarios. Scenario A, the Fed pauses. No more cuts.
That's the bull case. If rates stay right here, Banner's NM expands. That loan conveyor belt we talked about keeps repricing up by about 4 basis points a quarter, while their funding costs stay flat. They just make more and more money.
Scenario B, the Fed does one small 25 basis point cut.
Then M stays flat. The drop in what they earn on loans is basically offset by what they save on deposits. It's a wash.
And scenario C, the recession scenario, the Fed starts slashing rates.
That's where you see NM compression. If rates fall fast, their floating rate loans reprice down immediately, but they can't cut deposit rates fast enough to keep up. The margin gets squeezed.
So if you're buying Banner today, you're betting on scenario A or B. You're betting on higher for longer, or at least not lower fast.
You've got it. It's an interest rate trade dressed up as a bank stock.
One more thing before we wrap the analysis. M&A. Management seemed pretty open about it.
They did. They're on the offensive.
Yeah.
They explicitly said they're positioned as a consolidator. And it makes sense. Their stock is up, so they have a strong currency to buy a weaker competitor. They have excess capital. The herd is thinning, and they're one of the strong ones left.
All right. We've covered the margins, the fortress balance sheet, the expense noise, and the fact that people are apparently sobering up. Now it's time for my favorite part of the deep dive.
Oh, boy.
It is time for This Is Not Financial Advice.
And please remember, everyone, we are just two voices in your headphones. This is for entertainment purposes only. Do not do this at home.
Okay. I am calling this trade idea the sober pauser. It is a leveraged pair trade designed to capture everything we just talked about.
The sober pauser. I'm intrigued. What's leg one?
Leg one is the pause. We go long Banner Corporation, but we do it with call options for leverage. We're betting on scenario A. We think the Fed pauses, that NIM expands automatically, and the stock rips higher.
Okay, a straightforward bullish bet on rates staying high. So what's the hedge? What's leg two?
Leg two is the sober. We short the booze.
You're not serious. You want to short alcohol because of that one credit line.
I am absolutely serious. That $25 million downgrade, it's a signal. If the craft breweries are seeing declining cash flows, it means the consumer is tapped out on discretionary spending. So we short a basket of boutique brewery holding companies. Or maybe a consumer discretionary ETF that's heavy on alcohol.
So the thesis is, bankers stay sober, but the drinkers go broke.
Precisely. If the economy slows, the alcohol short pays off. If the economy stays hot and rates stay high, the bank long pays off. It's a beautiful narrative-driven hedge.
It is completely wild. And it totally ignores that people also drink more when they're sad. But I have to admit, the symmetry is just beautiful.
It's a story trade, and the data point is right there, buried in the footnotes.
Creative, I'll give you that. But again, listeners, please do not actually do this.
So let's bring it back to reality. Banner delivered a boring, beautiful beat, margins over 4%, credit is pristine, except for the beer, and a fortress balance sheet.
It really is a story of discipline winning over growth. And if you're watching this stock, just keep your eyes glued to that Fed dot plot. It's the whole dashboard for 2026.
Absolutely. Thanks for diving deep with us today. If you enjoyed this breakdown, go ahead and leave us a rating or a review, and we will see you on the next deep dive.
Stay curious.